In this video, you will learn what covered calls are and how you can use them to generate monthly income. So without further ado, let's jump into it. When I started my investment journey in 2012, I used to buy call options right before an earnings call to take advantage of quick stock movements. In other words, I was gambling and 80% of the time I would lose. Thankfully, I was only doing this with 5% of my portfolio. So after losing money for some time, I decided to just stop doing option investments altogether and decided to go long term for most of those stocks. Then after learning about options a lot more, I decided to go back in, but this time instead of buying call options, I decided to go on the other side, which is selling covered calls. I've been doing that ever since and making a consistent monthly income. I usually don't take that money out, I just simply reinvest it into other stocks. Now let's talk about how you can do the same and start making monthly income from your stock holdings. But before we actually start talking about how you can generate monthly income, we need to know what covered calls are. There are a lot of different options techniques that people use to make money, but in this video, I'm just going to focus on covered calls because options can be quite confusing. And once you understand the basics of options, then it's pretty easy to learn about other options techniques as well. Let's assume you own 100 shares of Palantir and you want to hold it long term. So one option would be to hold on to the stock, and if it goes up in value, you'll be able to sell it and make money. The other option is to sell covered calls while you're holding on to the shares to make a consistent monthly income. So to sell a covered call contract, you need to own at least 100 shares of the underlying company. So in this case, we are assuming you own 100 shares of Palantir, so you meet the first requirement. All the other things about a covered call contract are decided by you. You get to decide the strike price where the contract will be executed and the expiration date. Now these two things determine how much money you'll be able to make from a covered call contract. So let's talk about them. Strike price is the price at which your covered call will be exercised and your 100 shares will be sold at that level if the stock is trading above that value at the end of the expiration period. So as a covered call seller, you're hoping that the price of the stock stays below that strike price level at the end of the expiration period. Expiration date is also something that is decided by you. So on the expiration date, the covered call that you sell will expire. So depending on the value of the stock, whether it's trading above the strike price or below, you will be able to either hold on to the shares or you will have to sell them. To put everything together, let's assume you're selling one covered call to a friend and you want to write a written contract. In that contract, you will have the following language. Keep in mind that this is just for illustration purposes. When you are selling actual covered calls, you don't have to write any contract. This is all done by just clicking some buttons. The language in the contract will be something like this. I own 100 shares of Palantir, therefore I can sell one covered call. The stock is currently trading at $19 and I believe it will stay below $22 until January 7th, 2022. Now in this line, you are stating two things: strike price, which is $22, and the expiration date, which is January 7th, 2022. It will also say that if the stock is trading above $22 on January 7th, then I'll be able to sell you my 100 shares at $22, which was the strike price. So in this case, even if the stock price goes up to $40, you'll be required to sell it at $22 since that's the strike price that you agreed upon. You will also say that since you are taking all the risk, because if the stock price quickly rises above $22, you will lose on all the future gains. And if the stock price goes down, you will also lose value of your holdings. So therefore, you should get something in return, which is the option premium. Option premium is the amount of money that the call buyer has to pay you to take all the risk, because the stock value could go down to zero and you will lose all your investment, while on the other hand, they're taking lesser risk. So it makes sense for them to pay you option premium. While all of this is going on your side, the buyer of the call contract believes that the price of the stock will be above $22 at the expiration date of January 7th. But they don't want to invest the capital upfront. They don't want to buy 100 shares from the market, which will cost them $1,900. Instead, they go for the call option. By paying some option premium, they'll be able to control 100 shares of Palantir for 1 month. So that's the basics of covered calls. I do want to point out that there's no contract that is written. This is all done just by pressing some buttons. And usually the buyer of the covered calls is not even a human, but that's beyond the scope of this video. Let's look at an example to clarify this further. So Palantir is currently trading at roughly around $19. If you were to sell a monthly covered call, which expires on January 7th with a strike price of $22, you will see that the option premium is anywhere between 0.47 to 0.51. The bidding price of 0.47 represents that there are buyers of that call option that are offering 47 cents per share. And since there are 100 shares in a call contract, they're offering $47 to buy one call contract from you. On the other hand, there are sellers of that contract that are asking for 51 cents. So it means if someone was to offer them $51 for a full contract, they will be able to sell them that covered call. Let's assume you put in an asking price of 0.50 and your order is fulfilled. That means for your 100 shares, you will get $50. You pocket these $50 right away, and if the price of Palantir stays below $22 on January 7th, then you'll be able to keep your 100 shares as is, and you'll be able to keep the option premium of $50 for taking all the risk. If the price of Palantir quickly goes above $25 and it stays above $25 on January 7th, then your shares will be sold at 22. That was the strike price that you agreed upon. So you will receive 22 times 100, which is $2,200, plus you will get to keep the $50 call premium that you received. The buyer of the call contract is happy in this case because the stock is currently trading at 25 and they were able to get it at 22, which is the strike price. They could just simply take the shares, sell them in the open market, and make $300 minus 50, which they paid for the option premium, which will be $250. So their total profit will be $250 for this trade. So that's how covered calls work. If you're careful with the strike price and the expiration date, there's a very high chance that the option will expire worthless and you will be able to keep your 100 shares plus the option premium that you will collect. Now I will show you an example of covered calls that I sold on Palantir recently. I sold these covered calls in June 2021 with the strike price of $26 and the expiration was November 2021. For the most part, I go for monthly covered calls, but sometimes I go for the longer ones as well, depending on the option premium. In this case, the option premium was $3.32 per share. So for a contract of 100 shares, it was $332. In total, I sold 15 contracts, so that gave me $4,980 right away in June. At that time, the stock was trading around $25, and based on the history of this stock for the last couple of months, I believed it will be below $26 at the end of the expiration date. So to make $4,980 in profit, all I had to do was to hold on to the shares until November 2021, which was the expiration date, and hope that the stock price will be below $26. Fast forward to October 2021 and the stock was down to $23. At this point, I decided to close my position, and the reason for closing this position was the earnings was coming up next month, and usually Palantir runs up until the earnings date, and as soon as they release earnings, it usually sells off, so I wanted to take advantage of that situation. To close my position, I had to buy 15 call contracts from the market, and at that time, call premium per contract was $107. So therefore, in total, I had to spend $1,610 to buy back those 15 contracts. Since I received $4,980 when I sold the covered calls, and I had to pay $1,610 when I had to buy back those same 15 contracts from the market, I made a total profit of $3,370. So I made $3,370 in 4 months. On a monthly basis, this comes out to be around $842. Keep in mind that this initial call contract was for 5 months, but I closed 1 month early because I wanted to sell some of the shares right before the earnings call. So as you can see, selling covered calls can be a great source of income if you're holding on to the stocks long term. I currently sell covered calls in my regular trading account plus the Roth IRA account as well to generate additional money. Keep in mind, not all the stocks are best for selling covered calls. Even though you can sell them on pretty much all the stocks that are out there, doesn't mean you should. I personally sell covered calls on stocks that have recently gone down in value because of a bad quarter or something that's happening outside the company and it's out of their control. Usually the stocks stay low for a couple of months, so at that stage you can buy in the shares and start selling covered calls on a monthly basis. That is all from this video. I hope you got some value out of it.